Hey, this is Joe from AskJoeAboutMoney.com, and today is February 1st, 2023. And we're going to be doing our market recap today. We're going to go over three things today. We're going to go over first how I traded the FOMC news today, and then we're going to review two swing positions. And we're also, as we're reviewing the FOMC trade in the S&P 500, we're going to talk about the importance of position sizing. Where are we going to start off the morning looking at the 60-minute chart? And as we can tell here, the blue line here is the close. This is yesterday's close. We're going to start here and we're going to look at what's happening where we have, let's see if we could just zoom in more. We are going to have resistance up here. Let's go ahead and draw a line up there. You can all see resistance up here. Okay, and again, this is not a perfect art, but you could see that the market went up there, it rejected it, it went up there again, and rejected it again back on December 14th. We're getting close to that, so we need to be aware of that. We also know that the market is in a uptrend, as indicated by the trend lines. This is how I go in, and again, this is not predictive in nature. We're not trying to predict which way the market's going to go. The market could reach resistance and reject and come back down. We just need to be aware, because I call these inflection points, because as you can tell, if you just look back here, when the market came back up here to resistance last time, look what a big move the market had from there. The inflection points are really important to know, because that's going to be an area that I want to trade from. You always want to be trading from inflection points, because what happens is if the market doesn't have the energy to go through the resistance in this case, oftentimes it does the reverse, because it's going to try one way and then it's going to go, but the energy is going to go the other way. That's just what I do before the market opens, to have an idea of where I am, not predictive. And also today is a very important day because it's FOMC day. And during FOMC day, I need to really see something special in order to take a trade, because it is possible that the market doesn't do much. And I'm looking again at the open. I see what's happening. Here's the open right here. When I look at the open, what I'm looking for is enthusiasm. I'm not necessarily interested in trading the first 30 minutes or even hour for that case, but I'm looking for enthusiasm. Here we are. The market closed up here. We have a slight gap down. We opened down here, and we opened down here, and the first bar is a red bar. Let me just move this over here. That was actually the close yesterday. We opened down here. The market went down. Red bar, green bar, red bar, green bar. Two green bars is looking strong, but again, we have resistance up here. It's FOMC day, green, red bar. At this point, I've already concluded this is a 10.05. This is a range bound open, and I'm already at this point resigning to the fact that I'm probably not going to take a trade, because as it gets closer to lunchtime, and then at that point, then at 2 o'clock is the news. I think, yeah, right around this point, I just decided no trade for the morning. Guys, we have to be over this, right? Just because you show up to trade, we don't want to get involved in bad trades. And I'll show you what I did with the FOMC. I decided not to trade the morning, and there were some trades in there, but I like to swing trade. Here's the news. The news comes in at 2 o'clock. You can see the volatility starts at 2 o'clock. And what I'm looking for is a clear direction. I don't want to trade in this, at least how I trade. The market goes up, goes down. Market goes down, market goes up. At this point, we're 10, 15 minutes into it. A lot of wicks, a lot of volatility. Market goes down. Market, and this is the thing, is that during these news events we have to be ready to pivot on a dime, because we can't get fooled and say just because the market's going down, look at this wick 40.48 to 46. That's just the wick is 12 points. Just the wick is 12 points. And then we see this, and oftentimes this is just through experience, is that initial move down that we see down here is not the real move. Now I see this, and now I see this buying pressure. Now we're getting into 240. Now the volatility, it's going to be wide bars, and I'm going to talk about position sizing, but the volatility as far as the erratic behavior seems to be slowing down. So now I'm looking for a trade. Now I see this. Now here's the thing with this. Now this is really important, and I know I've been on the wrong side of this with the FOMC many times, and I want to teach you this. Here's the range for now. If we look at the range, the market, you could start from down here. The market went from 40.48 to 40.14. Right? That's a big range. Here's the thing. In the past, what I would say is I'm going to wait for a pullback, right? Because essentially what I would love to do after I see this is I would love to buy down here. But here's what I did today is once I heard that going on in my mind, I'm waiting for a pullback, is I just bought. Let me tell you why. Because what happens is when you see such strong bars like this, especially after the FOMC, by the time you're waiting for the pullback, that's all the longs already taking their profits. You missed the trade, and now you're buying at the wrong time. That being said, you have to position size accordingly because theoretically, your stop is down here. Now, again, it doesn't mean that you're going to take this loss down here. But you can't have, especially when there's this type of volatility, the mistake that we all make is having a tight stop. You need a really wide stop. This is almost like a swing trade. You have to look at the risk and say, because if the market did come down, because again, I don't know what's going to happen to the next candle, but I'm buying here because I see two green candles, a lot of buying pressure, and this candle closed pretty much at the top. So I am buying up here. I bought up here. Now, where's my arrow? I bought here. Okay, but I have to position size appropriately because if the market is a big red candle, I'm willing to buy back down here at support. But in my experience, most times you're not going to get that opportunity and you would miss the trade. So I'm long from up here with a really wide stop. Sizing is really important. Because my position sizing is much smaller than I normally trade, I'm able to, when the market comes down to support, now I have the mindset where I could actually buy more instead of selling because I position size too much up here. If not, you can't take the trade. The next candle is another green bar, another green bar. Again, at this point, I do see wicks on top. It does feel like it's slowing down, but let's see what happens. Now, here's a red bar. But again, here's the key. When we see this red bar, it's the reaction to this red bar, right? Are they going to sell this or buy it? Because if this is really strong, what should happen is, and when they see that this red bar closes, they should buy it because that was a buying opportunity. That was the pullback. That might be the pullback. And indeed they did. You could tell that there's a gap here. You can't really see it. But when that bar closed, it didn't even go, they immediately bought it right at that bar close. So like I said, this was, in my mind now, I'm long from here. And in my mind, now they bought it. Again, this is still strong a trend, I should say, and nothing to do. I'm holding my long. And so now what am I looking for now? I'm looking for a reason to get out. First, so again, my stop is still down here because again, what you don't want to do is you don't want to put your stop tight because what happens is position sizing can fix that. The reason why you have a tight stop is you're trading too large. My stop, I very loose, but again, I'm looking for a sign of a reversal and then that will get me out. I'm not going to wait for my stop to get out. That's just a protective stop. Now another green candle. Here we go. And now a red candle. Now at this point here, after I've seen this pullback, I see this red candle, I am going to be moving my stop. I'm going to be moving my stop to below this red candle. Because now at this point, I do want to capture, we got in here, 40.12, and we're up to 40.30. And again, we did get in late in the trend, but that's how it works with the FOMC. My stop's going to be below that red candle, and it got us out. That was the trade. The trade we captured basically from here to here. And that's it. It was a small size trade, and we had to get in late because after, especially during FOMC, because I didn't put it on big size because I was ready to buy it on a pullback, but I captured a small amount of the trade. What happened from there? The market actually continued to go up from there, and then it pulled back. That was a trade. That was a trade in the FOMC yesterday. The key is that when you see strong green candles and you're thinking of waiting for the pullback, just buy and buy at a smaller price, a smaller size, I should say. And then again, this all dependent on what happens. I never know what's going to happen in the next candle. But I do know that once I see this, it's unlikely that this is going to reverse because this is now at 240 and turn into a downtrend. I want to be long, and I did, and that was my trade on that. And next, we're going to talk about my swing trade in crude oil. The swing trade in crude oil. This is going to be on 15-minute charts, and this is going to be on the 24-hour chart. And when I look at crude oil, I'm looking at this, and we have the first move down. And now we have a broad bear channel. It's basically, we have the trend line going down this way. This is what I call my resistance zone up here. This is my resistance zone. Now here's the thing. If you're going to trade like this, you have to realize that you're going to be going counter trend on a short-term basis for the benefit of the long-term trend. Crude oil is in a downtrend. I'm thinking short because what happens is as we get the closer and closer, I would say the top third of this range here, I'm thinking short. But psychologically, the way crude oil trades, and the last trade that we took was a short up here, is that it's going to be green bars that are going to come up. And when it's coming up, because we all know that we should short at resistance and buy at support. But when it gets to resistance, it looks scary, right? It looks scary. As it's coming up to resistance, what I'm looking for is how does it react at resistance, right? What I did was, as it came up, I'm interested in shorting in this zone up here. The higher the price, the better. And I did short it up here. And then, at least for the short term, it has a wick. Now, you're going to ask me, where is my stop? My stop initially is going to be up here. My stop is going to be up here past the resistance zone because I may actually scale in and add some more if it goes past it, depending on what happens. It does hold there, and then it actually goes past it. Again, whenever talking about being precise, this is a swing trade that I'm willing to hold over several days. But what I am noticing is that it's not decisively breaking through. I could have added here if I wanted to, but I decided not to because I wanted to see what happens. Again, we are in the sell zone here. This is the sell zone. We have to be willing to position size properly. We have our stop above here, and we don't get stopped out in this chop. This is what's happening, and then it finally starts to come down. And once it starts to come down, at this point, what I'm looking at is oftentimes crude will race up to resistance and then race down to support, like right here, race down to support and race up to resistance. That's just how crude trades. I'm just waiting for some big candles, and now I'm starting to see 1, 2, 3, 4 red candles. And again, for me, I'm always looking to maximize my profit. I'm never going to let my trading profits dictate. Like, for example, I made too much money, I could get out. I am going to let the market tell me when I should get out. Again, now the candles are getting bigger and red. I wish I was short more. I'm not gonna cover yet. I'm gonna let the market tell me. Again, another big breakup. But now at this point, I'm starting to think. Now, once this happens, this could be an exhaustion candle, and we're also at support. All right. Now, once I see a green candle, I will get out above the green candle. At this point, I'm open for it to keep going, but a green candle will get me out. And we do get a green candle here, and I put my order. I think I put it right above the green candle, and I think it did hit me. Yeah, yep. I put my order right above the green candle, and I ended up getting out here. That was my crude oil trade. And again, the important thing is that when we're shorting at resistance, we have to remember that it's going to look a little scary, and we also have to give it some room because it's not perfect. Took heat before the market went in my direction. But then I was very quick to cover, and I let the market tell me when I should cover. And next, we're going to cover my gold trade, which was a losing trade. And there's also a mistake that I made on it, not because it was a losing trade, but I wasn't reading the market properly, and I want to review that with you. Now I want to review my gold trade. And the first thing that I want to make note of is that, let's go to the 60-minute chart. When I'm looking at gold, the first thing is that I already know that gold has been on a huge uptrend. Right? If we just look at this, gold has just been on a huge uptrend. If I'm going to be going short, I'm going against all of this. Now, it doesn't mean that you can't make money short. The market went down here, the market went down here, the market went down here, market went down here, market went down here, market went down here. And again, I would go and counter trend because that's market ebbs and flows. It doesn't go straight up. But I'm okay with that decision. But here is the thing that I think I made a mistake on, is that when I see this, let's go back here. I'm seeing topping action here in the gold, and basically this is, you can even call this like a head and shoulders. Here's the head, here's the left shoulder, here's the right shoulder. Market went up, it failed, went up, it failed, went up, it failed. It's making lower highs and lower lows, and then it finally capitulated down, and I was shorting the retrace. At this point, I'm with that, with the risk above here. But what happens is, once it does this, I'm willing to give it a little bit of room. But at this point, it's just I expected this to fail a lot quicker. The fact that it's consolidating up here. Remember, my stop's up here. But again, my stops is I very rarely get out on my stops. This was a situation where I got automatically stopped out. And I'm not happy with that because, again, I'm not reading the market properly, because now what's happening is it did this, it did that. I was expecting a rejection relatively quickly. And here we are, however many bars later. It's a long time. It's consolidating up here, just like it did here. And I probably should have just cut it for a small loss. I decided not to, and basically just held on to it, and then I ended up getting stopped out here. This one here could have been managed better by me reading the market and saying, look, this is consolidating here, get out, and then I could have just always got short again if the market broke decisively lower. This one was basically, I took a loss here from here to here. Again, there's always room for improvement. That was my original stop. And whenever I'm getting out at my stop, I'm always wondering, what can I do, right? Because the stop is there, but I'm trading really wide on my stops. I'm trying to read the market, and in here, in this whole area, I had plenty of opportunity to get out. I could have maybe cut that down, even if I got up here, or I could have potentially got out somewhere in the middle. I could have, and this is what it's all about. My loss was this big. I could have maybe made it this big. I could have maybe made it this big. I could have maybe made it this big. This is it. This is what trading is all about right here. It's about avoiding the bad trades and minimizing the losses on the losing trades, right? We could avoid the trades that are just going to be really bad, and we could minimize our losses. The profits will take care of themselves, and I could do a better job here, and we're always going to be working towards getting better at that. With that, trade Joe from AskJoeAboutMoney.com.